Morning, everybody. My name's Tim Dern. I'm a financial advisor in the area. Not working tonight. Nobody's buying you dinner. No one's trying to sell you anything. So we're just education. You'll hear a little couple of minute commercial from me. I do have business cards sometimes at the end of this meeting. If you're interested in talking to me about some of the stuff that I'm going to show you tonight, I would welcome that. If you have your own advisor or you do this stuff on your own, that's great. We have that too. But I'll give you my information as we go along and how that works for me. We are going to be talking about Social Security and retirement income strategies. In my profession, I tell you a little bit about my background. I'm a financial advisor, securities license, insurance license. But we do retirement income planning. That's what we do. So I'm really kind of in the retirement space. Most of the people that I deal with, 4 or 5 years out from retirement, many of them are already retired. A little different than just managing your money in a brokerage account. We're actually helping people on the drawdowns in their accounts. And what I'm going to explain to you tonight is when you're pulling out money, you get your Social Security benefit, that's taxed different than if you're pulling money from a 401k or an IRA. And we're going to show you some things that you should be concerned about. And I'm going to tell you some of the things I do with my own clients, so you'll be able to get a little bit of that, how that works. You'll get this today in the presentation. We're 90 minutes here. I've got a lot of information to cover. We move quickly. You're not going to be bored. There's a lot of updates and a lot of rule changes that just recently happened with Social Security. And I will tell you it's confusing. I had clients in my office today, and just to give you how this goes, I've got a lady that's retiring. We're putting her money in our brokerage account and different things that we do and setting her up for retirement. 62 years old. Just happened to see that she turned on her Social Security benefit. And I was just curious, just talking and conversation, I said, why'd you turn your Social Security benefit on early? You don't look like you need the money. Here's what she says, and I want you to know this is a common thing. In fact, she points her finger at me like this. And she goes, my sister said, get in there and get your money. That system's going broke. And get paid before that. She said, it would make me so mad if I passed away or something happened to me. I never got any of my Social Security. Anybody relate to this? Yeah. Now, I always kind of tease a little bit because I do stuff like this. I say, your sister works for Social Security? Oh, no, Tim, she works for Macy's. But she was online and she read and she saw. I'm going to tell you, that was the wrong strategy for her. I'm sure her sister, in all good intention, tried to help her, but don't let anybody tell you what's the best time for you or how it works. I'm going to tell you the information for you to make a decision, but don't kid yourself. Your neighbors, your brothers, your sisters, your people at work are going to tell you all the answers to Social Security, and this is really going to be your choice at the end of the day with all this, so keep an eye on that. But there are changes in rules. Make sure you take notes. I'm going to ask a favor just to hold questions till the end. We're kind of trying to get through a lot of material. I will be up here at the end of this, so if I did not answer your question, come on up. I'll help you out at the end, but if I start answering questions, we're going to drag on and it gets too complicated. Your benefit's different than yours and so on and so forth, so we leave the questions till the end. Fair enough? Again, I'm a financial advisor. I'm in this space. This is what I do every day. Nobody's buying a steak dinner tonight. No one's trying to sell you anything. I'm 68 years old. Married 43 years. Got 3 grown kids, 8 grandkids. This is where I am in my life. I haven't turned on Social Security benefit. I'll explain to you why. So I'll tell you when we have these different choices. But obviously we're here tonight. This is why I'm here. I'm very busy. I got a great practice, but this is a nonprofit organization that sends out the mailers and does the advertising for events like this. And this is my give back to the community. So I'm doing these educational events all over the area. Schaumburg, Palatine, Carroll Stream, you name it, we're all over. I got the offices in Naperville. We get around doing a lot of this kind of stuff. Really on behalf of this nonprofit. If you ever see that AFC logo, you go to my website, I'll give you my information, but you'll see a lot of things that we train and do education classes all over the community. You can go on and look at my calendar. If you see the AFC logo, you just know no one's going to give you a pitch. It's a free educational class. And that's what we sign up, and that's what we do. We're out here. Now, don't get me wrong. I get clients from here, so I'm not acting like we don't, but that's not my purpose here tonight. I'm not here just going to try to do education and show you some things here. We're going to do this in 3 sections. We're going to talk about Social Security. We're going to talk about Medicare Part B. Medicare Part B is tied into your Social Security benefit. And then we're going to talk about these retirement income strategies. And remember, when you're pulling Social Security, you're pulling from an IRA, you're pulling from a TOD account, you're pulling from a Roth. These are all going to be taxed different when you put your income stream together at the end. I'm going to just show you some strategies I do with my own clients. Again, you can take this information what you want. If you want to get more serious with me and see how it would work specifically for you, come on in and talk to me about it. Social Security we're going to cover. How much will you get? When to claim? How is Social Security taxed? Other Social Security benefits, spousal benefits, ex-spouse benefits, deceased spouse benefits, even disability insurance. So people come to Social Security through disability. And we'll talk to you about these new rules, and I want to make sure you're aware of them because some things, they've changed and people are making mistakes every day with this right now because they don't know or understand how these rules work. So we will tell you today. Medicare Part B, in this section, we're going to talk about the cost of Medicare Part B. We're also going to mention something you call IRMA, Income-Related Monthly Adjustment. Boy, is this a circus. This is a surprise to most people. When I'm working with clients and they're paying a fee for Medicare, and all of a sudden they get this big spike in their Medicare Part B, what is going on? I say, where are you pulling your money from? How is that affecting your IRMA? You're going to learn that too because there's something there. When to enroll in Medicare, when not to enroll, how to avoid penalties on Part B, we'll give you all that. The last section we're going to be talking about setting up reliable income sources. Social Security is one of those. You turn on a Social Security benefit, you're going to get those payments until you die. Maybe you have a pension, but we're looking for reliable income in retirement. If you got your assets and you're going to start drawing down on your assets, is that reliable? The stock market has been good, yes. We've all done well. How many think the stock market will be on the boom all the way through your 20 years in retirement? Is that going to happen? Probably not. Well, he's over here. We're all... When the market is dropping in retirement and you're making a withdrawal, I'm going to show you how that quadruples the losses in your accounts. We're going to be careful on that. We'll show you something. We are going to talk about reliable income. We're going to talk about RMDs and taxes on qualified money. We're going to show you how we teach our clients to survive these up and down markets in retirement. I'll show you what we do. And then are there some tax savings moves you can do with qualified money? We'll explain how well this works when we get to that section. This is my disclaimer. First of all, I don't work for the IRS. I'm not endorsed by Social Security, so I'm an independent advisor. I don't do taxes and I don't do legal work. Not giving any advice tonight. I am going to show you some things when we start talking about that income. You're going to want it. You're going to want to hear what I have to say. And you're going to understand it, but please understand, this is not what I'm telling everybody in this room to do. If we were going to give you a strategy personally for you two, we would have a lot of meetings, first of all, cover a lot of things before we just blanketed something out. But tonight, I want to show you some things that you should think about, and maybe you want to do this in your retirement plan as well. A little bit about me and my credentials. So first of all, I already told you I'm a financial advisor, securities, insurance. We do a lot of this. I have partners in a private wealth firm, so we're independent advisors. The key over there is fiduciary. If you have an advisor that you're dealing with, you should talk to somebody who's a fiduciary. You're going to hear this rule a lot. The fiduciary rule simply states that the client's best interest is always first. In our business, if we're managing your money in a brokerage account, we're getting fees on that. There's some cost to that. We would disclose what we charge our clients. You should know from your advisors what you're paying, but you need to understand how the advisor gets paid. If it's an insurance product, Medicare, annuity, life insurance, these kinds of things, we get a commission on these products. Again, if you're coming and talking to me and we're putting some things together, you would understand what we are recommending, why this is the best for you, how we get paid. Everything is disclosed. Not every advisor is a fiduciary, so you need to kind of keep an eye on that. Talk to your advisor about that. Now, my company is called Manna Financial. We got an office in Schaumburg, right by Whitfield Mall. Got one in Naperville, Illinois. We're recording here tonight. These young kids in my firm, they put this presentation on the internet, and I've got this across the country right now with clients calling me via Zoom. from Social Security and educational things like that. So I'm licensed in 28 states besides this here. If you're interested in some of this stuff, you'll go to my website. You'll see a lot of our YouTube videos if you're interested in that. These are a couple of those young guys that work for me. We got a lot of these guys in here that are working with me for helping out. And the older guys get older, the younger guys start coming up, that kind of stuff. But everybody in our firm that works with us is a fiduciary. So that's it. This is the private wealth company. They have an office in Oak Brook and also one in Denver, Colorado. This is the group that we do all our brokerage account investments through, and I'll tell you a little bit about that later on what we do. Our money is at Schwab, so if you're interested in ever coming over to us, that's where we are. They're the custodian for us. Besides all these things I'm telling you, I have a couple of certifications you should be aware of. Number one, I'm an RICP, Retirement Income Certified Professional. So that's what, I have a deep training into Social Security, Medicare, and income planning. When you start drawing money out of your account, if you have an advisor you've been feeding money to and they're managing you in a brokerage account, nothing wrong with that. But when you start pulling money out of these accounts, sometimes the advisor doesn't understand this phase of life. And if not, you could be paying a lot more in taxes or maybe working on a drawdown that's too much. We're going to show you kind of what we do. But besides that, I've had to pass a course, take classes, pass exams, get it. I have this designation as a National Social Security Advisor. And I know a lot about the rules and regulations in Social Security. I'm going to share with you today how it works, but I'm also going to stay, I'm up here bragging, telling you all these great credentials. You may come up to me after this and say, I got a question. And I might not be able to answer that question. And if I can't answer it, I'm going to tell you I don't know. But I'm going to share you this. I can call my team here and probably get an answer to your Social Security question faster than you'll find it on the internet or call in the Social Security Administration office. So I would encourage you, if you do have a question, come on up at the end, we'll make sure we handle that. Different publications. Again, you'll see this on my website. I write a lot of Social Security strategies, mistakes that people make when they're claiming Social Security. A lot of this stuff I'm out there. This is a television show. It's actually airing across the country now. 5 keys of successful retirement. So you see some of that on there. I've been on a lot of the local news. This is WGN, segments here, Fox, ABC. Get a lot of publicity in the area here. This is my office in Schaumburg, right across the street from Woodfield Ball. This is an office that's out in Naperville, kind of 88 and 59. So we got a couple of offices here, and we kind of work all over the Chicagoland area. Up on my commercial. Let's start by talking about the risk that could disrupt your retirement. A lot of clients come into me and they do this thing where the Social Security is going broke. We already talked about that, and they're concerned, will Social Security be here? So we're going to cover that, talk about it. But think about these risks. Market risk. If the stock market crashes when you're in retirement, you're not contributing anymore, you're doing your pull out your money and living, we got to worry about the market a little bit more now because you're not contributing. Income, outliving your money. This is a fear people have. They get to the end, they got all this money. Tim, can I retire? Do we have enough to retire? And I'll show you how we come up with some of that stuff. Health risk, boy, people are very healthy. You get to 65, 66, things start to happen. But I do see people have heart attacks and strokes. Did that disrupt your retirement? Oh yes, are you prepared for that? Did you plan for that? Do you have something? We'll talk to you about that. Tax risk. Taxes will be surprisingly more than you think they would be in retirement. We were all sold this idea that we would kind of not have a very high income tax bracket in retirement. If you've got some dollars saved up and you got some qualified money, 401k IRA, I'm going to show you what happens when you get into retirement on that. This is the one I want to highlight, legislative risk. This is Washington changing the rules. Changing the rules on Social Security, changing the rules on Medicare, changing the rules on how your 401k, 403b is taxed. And they've already started changing these rules. If you don't think this is happening, I'm going to show you they're after all of our retirement money, qualified money, IRA, 401k, this kind of stuff. The country's $34 trillion in debt, yes? Baby boomers and people are retiring with trillions of dollars in these accounts. They've already started changing the legislation, things that are happening. I'm going to share a couple of these things with you today. So I'm going to explain to you what's going to happen to your 401k or your IRA in retirement based on these new rules. So the first section, let's start talking about Social Security. Now it started with President Roosevelt. He signed this into law in 1935. What I found interesting about this is in 1935, he said when you turn 65, you're going to get this benefit. It's going to pay you until you die. What do you think the life expectancy of a male in 66? A female, 68. How long do they intend on carrying people on Social Security? Not long. Now here's what I think is just, I can't hardly believe this. They didn't change these rules for years and years and years. We're still living off these old rules thinking people are going to die off early, and people are living into their 80s and 90s, and Social Security and Medicare are getting overloaded. Yes, they started changing rules to try to shore this up. It's just funny that they've been waiting so long, but they've just started making a lot of new changes because they see people are living longer and we got to do some things. But one last thing about this, Roosevelt said in the law, he signed it into law, you would not pay any income tax on your Social Security benefit. That was the law. How many know that's changed? How many know your Social Security is subject to tax? Some people think it's not. It is. I'm going to show you how that works. This is item A. She's the first Social Security check. 22 bucks. And I'll bet that was a big deal back then. But anyway, she was the first person that got a Social Security benefit. Social Security today, 200 million workers are covered under Social Security. 70 million people are collecting a benefit. It's $1 trillion we're paying out here. Now look at this. Of 70 million people collecting a benefit, $1,900 is the average benefit. You're not going to get rich on your Social Security benefit. I'm going to explain to you how they calculate your number. Some of you will get more than this. Some of you might get this. Some of you might get less than this. But usually what I find is I have couples that come in, you know, maybe they make a couple of $100,000 between the two of them a year, you know, so they're usually getting, you know, $10,000, $12,000, $15,000 a month, and then they look at their Social Security benefits and they go, what? How am I going to do this? It's going to be a little different when you do this. So Social Security is not going to be your major asset probably in retirement in most cases, but in many cases it is. Sometimes this is the money that people live on, so we're going to explain how this works. I would make note of this. These are the changes for 2025 that you should be aware of. First of all, there's an increase, a COLA, cost of living adjustment, 2.5% this year. If you are collecting a Social Security benefit, or you're about to, you're going to get a little raise. Last year was 8.7, a lot bigger raise. Now I'm going to stop here for a second. Anytime, this is my financial advisor talk now, you start seeing a cost of living adjustment on Social Security, it's an indicator for us that we got inflation going on in this country. So even when it was 8.7, everybody was bragging and, oh, I'm going to get a raise in Social Security. I said, have you seen the market? Have you seen what's happening with inflation? So we got an indicator that it's still having inflation right now. And I'll tell you, even though that's a cost of living adjustment, still doesn't usually keep up with inflation. But that's a new one for this year. Here's something else you're going to notice. You're paying in and contributing to Social Security more money now. You used to contribute to Social Security up to $168,000 a year. If you made $200,000, you're stopped contributing at $168,000. Now look at this. It went up to $176,000 this year. We're paying more into Social Security. Keep an eye on this, because I'll tell you what's happening next year. They're going to keep increasing this. Why? Because Social Security needs money. Medicare Part B, last year was $174,000. This year it's $185,000. That's the base for Medicare Part B. And then we have to start looking at how does Medicare Part B increase based on income-related expenditures that you do. So we're going to explain how that works. How do you pay into Social Security? Well, it's FICA. So this is being deducted from your check, or if you're self-employed, you're paying this. But 7.65 for the employee, 7.65 for the employer. Again, 15.3, that's up. Used to be 14, it's up. More money coming out of your check. Some of that money is for Medicare, so you're paying Social Security and Medicare. And if you make over $200,000 single or $250,000 married, you're paying even more money into Medicare. Most people are not seeing these increases because this is just coming out of your paycheck, but everybody is contributing more into the system right now. And keep an eye on this, it's going to even get more and more as we go along. We'll be talking about two trust funds. One's called Old Age. I love this. Old Age and Survive. You're just going to survive. And then they have a disability insurance. These two are important, and we're going to make sure you understand how it's paying what benefits out of which trust fund. Here's something most people don't realize. Look at this. Current workers contributing to Social Security right now. Me. You. We're paying into Social Security. We're the ones paying for the retired workers' benefit. What? I thought this was the national debt. Who's paying for Social Security? We are. Now again, if you know anything about this or you follow, when we look at jobs reports or any of these things that are talking about unemployment, one of the indicators we're looking at is Social Security is dependent on workers paying in. 2 years ago, it was 7 workers. It was 3 years ago, because we just hit the year. 3 years ago, 7 workers for every 1 retired. Now, 3 workers for every 1 retired. We are going to be, you and me are dependent on the workforce behind us to keep this thing going. This is a Ponzi scheme. Really, I mean, it's scary when you think about it, how it's funded, but if you think it's the government funding and all that, it's not, it's workers. So do we have an interest in the workforce in the future? We do, all of us do. Social Security, will it be there for you? You've been paying into Social Security since you got your first job. And you've been paying and paying and paying, and now you got to come around and you say, okay, well, how do I start collecting Social Security and how does it work? Again, this question we always answer up front, is Social Security broke? How many think it's broke today, right now? How many don't know? It's not broke right now. So the reason I want to bring this up is if people are, and maybe you're one of them, if you're wanting to run in and turn your Social Security benefit on as soon as you're eligible and grab it early because you're afraid that this is going to be broke, I want to assure you it's not going to be for this. And don't make that your number one reason to do this. There's other reasons you should claim a Social Security benefit, and the thing I want to make sure everybody understands, once you claim your benefit, that's it, you freeze it for life, you can't change it. So we have to think about this a little bit more. But there is a lot of evidence out there and a lot of people talking about Social Security and the shortfall, 1/3 short by 2034. This is the scary part. I have clients where I have their money in retirement. We are taking some of this money and we are putting a bucket of money out there, preparing that what if this happens, we have some money earmarked to make up that shortfall if it does happen. I don't know if it will happen or not. I happen to think that it's going to be fine. They've been looking at this since 2017. They've been making some changes, but I do think Social Security for our age group is going to be okay. My children, my grandchildren, I have no idea what this is going to look like. I don't even know if this will be around by then. So if you're a little older right now, I think we're going to be okay, but in the future, they're going to have to make some changes. We'll see what happens. That's what I believe. But we're all going to see, 2034, we'll see how this works. Eligibility for Social Security. You have to be eligible. This is those who have paid into FICA, and look at that. You have to pay in at least 10 years. This does not have to be 10 consecutive years. Maybe you worked 3 years, we're getting FICA wages taken out. Then maybe you started having children and raising children and you didn't go back to work for 20 years and then you came back. So if you started, stopped, as long as you have 10 years accumulative, you're going to be eligible for a Social Security benefit. If you don't have 10 years, and I find this with people. I just had a lady last week came in, we looked for a Social Security benefit. No, don't have benefit. We did some more homework. She had 9.2 years. She needs 10 years. So go get a job, clean it up, and then you have 10 years. So we have to look at that. The next one is you have to age in. You have to qualify with your age. It was a little funny to me when my name starts coming on the Medicare card. I thought it was my dad. Now it's my name on these crazy cards, but you age in. That's how you become eligible for Social Security. Now look at this with the spouse, ex-spouse, deceased spouse. Between a married couple, a little weird. If you're married, you could be somebody who's never worked outside the home, never paid a dime into Social Security. Maybe you weren't even born in this country. You marry somebody who's collecting a Social Security benefit, can you get a benefit as a spouse off of their benefit? Yes. What about an ex-spouse? Yes. What about a deceased spouse? Yes. We're going to explain all that. And then dependent children, dependent parents, we'll talk a little bit about that. And then, of course, disability. A lot of people come to Social Security through disability. Here's a question, just a fun fact. When people come to me and they're on disability, they've been collecting for a while, they'll say something to me like this: hey, what happens when I turn my full retirement age? What's going to happen to my disability check? Because they're concerned, you know, I got Social Security early basically on disability. So here's what happens. If you're on disability, nothing happens. In other words, they're going to pay you your disability check until you turn your full retirement age, and then they're going to pay you the same money, but now they're going to call it Social Security. They were paying you out of disability, now they're going to pay you out of Social Security. You don't file, you don't do anything, this just kind of happens automatically. So if you're on disability, you don't really have to do anything, but look at this. Not everybody's participating in Social Security. Illinois teachers, many of them are not participating in Social Security, have teachers' pension. Railroad workers, ministers who elect out, so not everybody gets a Social Security benefit. You have to qualify to get your benefit. We'll explain how that works. I want to start with this rule before I start sharing you with the benefits. This is something called file and suspend. This was a strategy, a switching strategy between a husband and wife that we were all doing years ago. And it's been gone for many years. And the reason I bring this up, yesterday in my office I had a couple that came in and we start talking about income and okay, let's talk about Social Security. And the gentleman who I was with, he barely even says hello. He just kind of gets in there, hey listen, I want to do that thing my brother did, that switching strategy with Social Security. Not even like hello, he's right in my face. I want to do that switching strategy. So let me explain how this worked, because this is what he was after. There was a time, can't do this anymore, somebody get you excited, but you can't do it. Me and my wife have Social Security benefits, so I could file for my Social Security. File, but suspend claiming it. She would file and suspend claiming. This allowed me to go and take half of her money. She wouldn't go and take half of my money. We would let our own benefits continue to grow, and then at a certain age we would switch back, and we would double dip the system. Everybody was doing this, and I spent all this money on software, and you came in, I had to run all these numbers, okay, you go here, you go there, we do this, and government came in and said, why? Because Social Security's going broke, and they had to shut this off. Here's what you need to know about this, and here's what I was trying to tell this person. Your brother did that. How old's your brother? Of course he was older. Yeah, he could do it, but you can't do it because this rule changed. Some people think they can still claim half of their spouse's benefit, and they go do that. And what then happens is that freezes their lifetime benefit to the half of the spouse. You never get your full benefit, because once you claim a benefit, that's it. So just keep in mind, whatever benefit we're going to talk about, the ones you choose, that's it. You can't switch anymore. One guy told me, you can, I saw it on the internet. I said, no, you can't. And then he did it, and then guess what happened? He can't. So I bring this up, file and suspend, a switch strategy between husband and wife cannot longer do. Can't tell you enough of that. We're going to learn that Social Security eligibility starts at 62. And then you're going to see an 8-year window where if you delayed a little bit every year, your Social Security starts out smaller, and if you delayed and all the way till 70, it increases a little bit as you go along. So all of us have to decide when is the year that you're going to want to turn on your Social Security benefit. So here's my question to everybody in the room. When's the best age? Who's been on the internet? You've done the math. We got some Rockefellers in here. They know the answers to this. Who knows? Take a guess. What do you think?
70.
70? What else?
68.
What?
78, 40 meters.
Doesn't say 70.
When am I going to die?
68.
Depends on your house. When am I going to die?
Right? All this is right. When people ask me when's the best age, I say there is no best age. Not for everybody. It's all of what you guys are saying. Personal choice, experience. I love this though because I have friends of mine, they go, you know, Tim, I'm going to go in and get my Social Security at 62. I say, you don't need the money. Yeah, but I'm going to die early and it's going to make me mad if I don't get any money. And I get what they're saying. I want to get money before I die. I said, what if you live to 85? You know how much money you're going to leave on the table? What I tell people when we consider this, I say, first of all, I tell my clients, when do you need the money? Some people at 62 aren't going to have any other money, and they're going to need their Social Security benefit, and I'm going to say, take it. Some of you are going to be like me. I'm 68. I don't need this money. I'm working. I'm trying to delay till 70 and max it out. But every one of us have to kind of take a look at these numbers and kind of decide. Life expectancy plays in, employment status, maybe you're working, maybe other sources of income. But we do have people, when we start talking about Social Security, and I'm going to say it to you this way as an advisor, sometimes the Social Security benefit is a small piece to your overall assets. You got a couple $1 million in investments, Social Security is not going to be your main deal. So you might, if you take it early, late, whatever, it may not make that much difference to you. But if Social Security is a bigger portion of your income in retirement, well then we got to be careful with that and we try to get you more money because now we need a higher payment for the rest of your life. So everybody's situation is a little bit different. We all have to decide, are we going to keep working or are we going to retire? And I deal with this every day. People make a lot of money and then we go to retire and they say, oh boy. I find that this last year, a lot more people are working longer. Just, there's a lot of good things about the economy, but cost of living is up and prices are up and there's a lot of things. So, but you have to make your decision. Now, if you have other money, 401k, IRA, and you're going to collect with Social Security and you're going to, now this is a little bit easier. But again, we got to start doing some math here and see what your income is going to look like when you're in retirement. Your Social Security benefit, first of all, guaranteed for life. So if you turn on your benefit, you're going to get paid for life. Now, fun fact about this, I'm just telling you different things that happened to me. I had a couple that came to me, husband and wife, both born in April. When they went to claim their Social Security benefit, they thought they were both going to get the Social Security benefit at the same time. One got it the second week and one got it the fourth week. Anybody think maybe why? Day of the month of the birthday. If you're on the 12th and I'm on the 24th, they come at different times. But once they establish when they are, you will get that check every month and you will get it until you die. The money comes for life. Used to be a $250 one-time death benefit, but they raised it. Anybody know what the new amount is?
$255.
How much?
$255.
How do you know that?
Internet.
Yeah, stupid internet. Yeah, they raised it now to $255. Is this wild? So if I'm collecting a Social Security benefit, I die, Social Security comes over and gives my wife a check for $255. What you do with that, I have no clue. Here's the thing that I want. You will get cost of living. I'm going to make this, keep an eye on this. Social Security is a tax-preferred asset. And if you have an advisor that understands how to work with this, I'm going to show you how we can mitigate some taxes in retirement. You'll catch this. But we do it because Social Security is taxed different. I'm going to explain that how that works. So let's talk about your own benefit. This is what you need to know about your own benefit. So I would take notes here. First of all, you need to know FRA and you need to know PIA. FRA and PIA. This is the jargon. This is how Social Security talks. If you're calling the Social Security Administration office or you walk in, have you done this? They're going to start saying FRA and PIA. And you're going to go, what the heck are you talking about? So first of all, FRA is full retirement age and primary insurance amount. So let me explain how this works. So first of all, your full retirement age is really just the year you were born. So you look at the chart over there, if you're born between 43 and 54, your full retirement age is 66. I've highlighted me, 1956. It says 66 and 4 months. 66, 6 months, 8 months, 10 months. And of course, if you're born after 1960, then your full retirement age is 67. Here's the reason I point these out. I have had clients come see me telling me the last advisor they had told them that these extra months don't matter. And I said, what? Yeah, that was told it didn't matter. They matter. And I'm going to show you, if you get this wrong, what happens to you. Again, careful where you're getting your information, because not all the advisors, not all CPAs, not all lawyers, not everybody understands how Social Security works. You're thinking where you're going to get your information. Make sure you got somebody who's got the credentials to give you information about this, but I'm going to tell you these ones matter. So full retirement age is based on the year you're born. Primary insurance amount, this is the dollar amount you will get from Social Security at your full retirement age. Here's the confusing part here. They're not sending out statements as much as they used to, but at one time they were sending out these statements. Sometimes you'll go online and you'll see a statement online. In the top right-hand corner, it'll say $2,100 Social Security benefit. That is your PIA. That is what you get at your full retirement age. That is not what you get at 62. 62, you are going to get less. So be careful when you're looking at these reports. It's always showing PIA. That's the full retirement money. And then, of course, if you go early, you're going to get a reduced amount from that. So we're going to explain that to you. How do they calculate this? It's based on your earning record. Now, you have to have 10 years of paying in, but then they're going to take the average of the highest 35 years of your career. Early in my career, I was a McDonald's person. I was a waiter. I think about all these jobs I had that weren't paying much money. I had businesses earlier didn't do well. Making a lot more money now. Are some of these dollars and tax returns I'm turning now could pull out and make me a higher average in time? Absolutely. Many times I see this with women who stayed home to raise their children, got out of the workforce for a while. When they get into retirement, before they go, I say you got a lot of zeros in your 35 years. Why don't we work a couple of more years? Why? Because you can increase your PIA for the rest of your life if you just did a little bit more work. So sometimes we look at that, but it is 35 years. They do index them for inflation. They come up with a number. I'm going to show you where you find this. Where do you get this information? SSA.gov/my account. If you haven't done this yet, you're going to click on this little blue button and you're going to create an account. Name, Social Security number. I was a little bit surprised at how much they already have on me. And they have your tax returns since you were like the first job you had, flipping hamburgers or whatever it was. And they're going to show you your earnings record, and they're going to show you what your PIA is. They're going to tell you how they calculated the number for you. Between a husband and wife, it's probably going to be different because we all have different records. But you're going to see in this same file here what's your earnings record, and they're going to tell you what your money looks like. Now, this is the sheet that's inside there called the retirement estimator. They're going to estimate your earnings because you haven't turned it on yet. Now, this is a little older form. They've updated this form now, but this is the easier one to teach on. So what I'm going to show you when you look at this, they're going to say, based on your earnings for your career, what is your money at PIA? In this case, $2,370. But what if I claimed early? Well, I get $1,639. I don't get this, I get this. Or if I delay to 70, I get this. Depending on where you are, if you came working with me or you have an advisor, my first thing is when we start looking at income plan, I want to know these numbers. What are you going to get from Social Security? You're used to making 10 grand a month. Social Security is going to give you 4 or 5. Where are we going to get the other 5 grand a month from where? And then we start talking about assets and whatever. We start to try to build that up and help people. But we want these numbers, and then it can help you decide when's the best age for you to make a decision here. This is the chart that's in your book too, but I want to kind of explain kind of how this works. This is that window 62 to 70. You'll notice here, I'm just going to use the 0, and I'm going to say if my full retirement age was 66. What this 0 is saying is nothing is added to my check, nothing is subtracted from my check if I claim at my full retirement age. So if I'm going to get $1,000 a month at my full retirement age, I get $1,000 right here. But if I'm going to get $1,000 here and I claim it early, I'm going to get a 25% reduction. I'm only going to get $750 a month, not $1,000. Everybody clear on that? It is for life. My friends say, yeah, I saw that, but I'm going to collect, and I'm going to change it later. Look down. You're gonna change it? How are you gonna change it? They say you can't change it, I say you can't change it. So your decision's gonna be based on that, but notice if you delay every year closer to your full retirement age, they subtract less. So every year you're delaying, your money is increasing. Here's interesting. If you can go past your full retirement age, like me, I'm past my full retirement age. Well, then it grows by 8% a year. I'm going to stop for a second and pause. I'm in the investment business. You got investments. Shout that one out you have that's 8% guaranteed for the rest of your life. I'd like to hear that one. It's a pretty big deal. But if you can delay, your amount goes up. This 8% a year is actually prorated by the month. So if you waited 6 months, you would get an increase of 6 months or 8 months or whatever. But usually if you just kind of in your mind, the longer you delay Social Security, the more money you're going to make on your own benefit. So if you had a small benefit and you're somebody who we need to get that benefit up because this is a major part of your income, we're going to talk about working longer, we're going to talk about things, we're going to delay your benefit to try to get it as high as we can. If you're somebody who's not a big deal, and you go here or here, sometimes it doesn't make any difference. I do have clients, and I'm going to say it to you this way, it's kind of funny, they come in and they go, Tim, I want every dollar out of Social Security. I want to max this thing in their mind. I've been paying in my whole life. I want every dime. I go, okay, great. Here's how I can max this out right on the nose. Tell me when you're going to die, man, and we're going to nail it. And we don't. So you're never going to nail it. You're not going to. So we kind of work with you and try to find your benefits, but this is the chart. Please remember this stops at 70. I had a gentleman in my office, he was 71 and a half. He didn't turn on his Social Security. I'm sitting there with him, I said, how come you didn't turn your Social Security on? He said, hey, my brother told me. I said, oh, your brother. He said, max it, baby. I said, what did he tell you to do? 72. I don't know where he gets that. I said, well, 70. Those extra 2 years, they don't backdate those 2 years when you turn on Social Security. They will backdate as much as 6 months. But a year and a half worth of benefit, his nice brother just cost him. Because you don't get it back, and it doesn't grow anymore. So I also had people tell me this, and this is more on the sadder side, 72, 73, how come you didn't turn on Social Security? And I say this in humbleness, they say, I don't know how to do it. I thought they were going to call me. I don't know what I got to do. And I think, wow, okay. So I'm going to show you, you're going to have to apply. You're going to have to claim your benefit because some people in all heart, they don't know. And how many think Social Security will call you? Hey, we got your money. Ain't going to happen. You're going to have to find out on your own. Make a note of these just so you know. There is max benefits to Social Security. So what they are for 2025, if you turned your benefit on at 62, regardless of how much money you've earned, the biggest benefit you could get at 62 is $2,831. 67, $4,000, or 70, $5,000. This is the max benefits. The reason this is important is somebody comes in and say, I want to turn my Social Security benefit on at 67, and the benefit is like $4,000 to $3,900, I'm going to say you're right here. But if you're going to turn it on and that's $3,400, I said, well, maybe you could work a little because you could do some catch-up. Or even here. So we kind of play back and forth, but there are max benefits to this. So some people say, what if I make $2 million a year? Well, you're going to get $4 grand because that's what the max is. That's how it all works. I'm going to pause here and talk to you about this, and this is my warning. If you turn a Social Security benefit on early and you are still working, you are going to be subject to penalties. And I'm going to tell you how this happens. Again, I'm going to use my friends. I'll be on a golf course, and a guy will say to me, hey, Tim, I found a loophole with Social Security, my buddy. And all I think about is all the money I paid for these classes, all the training I've had, all this crap I had to do, and I'm like, wait a minute, I don't know the loophole. What's the loophole? He says, I'm going to turn my Social Security on at 62. I don't need the money, but I bought a condo in Florida. I'm going to use it to pay. I'm going to invest the money. Tim, I'm going to invest. You ever heard this? So here's my warning, because I see this every month. If you claim Social Security early, any time early before your full retirement age, you're subject to an earnings amount. If Social Security says you can only make this limit, and if you go over that limit, watch what happens. So, the annual earnings test, AET is the way Social Security claims this, you will have penalties if you go over this limit. Now, this chart is in your book, so you'll have this for reference, but I want you to pay attention to the screen. Now, I'm going to tell you that there's a lot of financial advisors, and maybe yours is this way, so ask them. There are people that don't even know in our business what's included in this earnings test. What's included? So I want to start by telling you what's included. First of all, if you look at the top up there, it's your own wages. So if I turned my benefit on, they're going to look at what I make. Not what my wife makes, what do I make? My own wages. My net profits from a business or any commissions. I've had people that came in and said, oh, yeah, my last advisor said I'm a realtor, I get commission, doesn't count on that. I said, oh yeah, it does. I've seen people that have retired, left the business, their kids are running the business. They're not even getting a paycheck anymore, but they get profits from the business. And it smacks them on their Social Security penalties. So be aware, or have an advisor who is aware of this. What's not counting in this? IRA distributions, meaning you could pull Social Security and take money from an IRA. Doesn't matter. Investment income doesn't matter. Rental income doesn't count. I love this, lottery winning. You can only make a little bit, but if you win $1 billion, that's fine. Who makes the rules? So this is the chart. Now I'm going to show you me, 66 and 4 months, full retirement age. Watch what happens here. If I turn my Social Security on at 62, what can I make annually? $23,000. If I go over that, I'm paying a penalty. What can I make at 63? $23,000. What can I make at 64? $23,000. What can I make at 65? $23,000. See how this goes? What can I make at 66? Well, now I can go up to 66. But when I turn 66 and 4 months, 66 and 8 months, in other words, when you hit your full retirement age, there is no earnings test. I see this penalty a few times every month. Every month. Downtown, made great money. She came to us at 62. She says, listen, I'm going to retire. Got money. And she says, I'm going to turn on my Social Security. I said, okay. She said, I'm going to work part-time down at the firm. I said, oh, wait a minute. You understand you can only make a certain amount of money. Yeah, I got it. And for a couple of years, everything's fine. So she comes at 62, we started. At 64, we're doing an annual review, talking about her money and all this stuff. And then we get to the point where she says, hey, and you got to figure out, you got to call my Social Security check. You got to get it straightened out. And I go, what happened? She said, I haven't had a Social Security check in 8 months. I said, oh, wait a minute. Are you still working? Yes. What kind of money you make? Make more than $25,000 or whatever? I don't know. Well, she made $63,000. The earnings test back then was 21. She's 41,000 over. So what happens on this is they send her a bill for $20,000. How many know about this? You can't pay this bill, they turn off your Social Security, they stop it. Involuntary stop. Do people know this? They turn it off. I can't turn it back on. Call your mom, they can't turn it back on. What happens is Social Security will stop it. They will say you can turn it back on again when you reach your full retirement age. And they will go through all these months that you didn't get paid, and they will recalculate a benefit, and they will redistribute your money, but you can't get it for 2 years. And every month I see this. I'm going to invest the money. I'm going to take the money early. So what I want you to be aware of, when you turn your Social Security on before your full retirement age, check that chart. Now, I will say this to you, okay, and you know, when this happens, if you turned it on early and you don't get to 12 months, so you're 6 months in and you go, whoa, I made a mistake. You can take the money you've got from Social Security, give it back, no interest. Somebody told me you got to pay the interest. I'm not aware you do. I don't think you do. They just, but they'll give you a do-over. But if you had that payment 12 months, you're locked in. So earnings test. So if you're my client, you came and saw me, we start talking about Social Security, and you say, I want to turn it on. So wait, are you working? How old are you? We try to tell our clients, if you can at least wait till full retirement age. If you could, then wait till full retirement age to turn your Social Security on, because then I don't have to worry about any of this other stuff. You don't necessarily have to wait till 70, but if you can wait till your full retirement age, you have to worry about that. But if you have plenty of money, and you're going to retire, and you're not going to get a job with wages, then who cares? Because all your investment money does not count on this, to help you on that. How about a spousal benefit? This between a married couple. I have a Social Security benefit, my wife has her own benefit, but we can decide. If I'm getting $2,000 a month, my PIA, and my wife's own benefit might be $600, if she didn't work as much as she's raising the kids, she would have the ability to go and take half of my $2,000. I would get my $2,000, she would get $1,000 for her, which is better than her benefits, and that's called a spousal benefit. Now here's the new rule. I have to be claiming a Social Security benefit before she can even get half. So first I have to turn it on. Second thing, she has to be her full retirement age to get the half. If she takes less, if she goes earlier than her full retirement age, less money, subject to the earnings test. This was a real conversation with me and my wife. At 62, my wife's going to turn your Social Security on. I go, wait a minute, I make way too much money. Well, I want my check. What we did, she collected her own. Because when she turned her benefit on, I'm over here making money, it didn't affect her. She got her own, now she forfeits coming and getting half of mine, because she took her own. So a lot of times when we're talking to couples, and we would do this with you, Brenda, we'd start talking through this a little bit and say, does it make sense? But once you claim the benefit, you get half if you're at full retirement age, but once you do that, you can't switch. So if my wife claimed her own, that's it, she claims half of mine. Just understand that her $1,000 take of mine does not affect me. I get my two, and she gets her one, does not affect me. So keep that in mind. Let's do an example here. Tom, he's got a PIA of 20, this is Tom and Susan, they're married, just in case I didn't cover that. They're married, Tom's 2,400 PIA, but he's collecting $3,000, how can that be? He only gets 2,400, how's he get 3,000, what happened? He delayed. He delayed till he turned it on. So he's getting more than his PIA because he delayed. But now his wife comes along and says, hey, I'm my full retirement age, so I want half the money. My question to you, she get half of the 24, she get half of the 3,000. What does she get half of?
24.
She gets half of the PIA.
Wow.
Tom gets 3, Susan gets 12. They get a combined 4,200. If my Social Security benefit was $2,700 at 66 and 4 months, and I delayed till 70 and it's 4,000, my wife still gets half of the PIA, not the 4,000. Okay, so keep that in mind. These credits, they're called DRCs, delayed retirement credits, don't count on the spousal benefit. So keep this in mind. Now, if you have an ex-spouse, works the same way. The rules are you have to be married at least 10 years and divorced for 2 years. And you have to be at least 62 to claim this benefit. But I will tell you something, I see this a lot, where I have ladies that come and see me and they're divorced. And they say to me, my bigger benefit is on my ex. Half of that benefit is higher than my own, but they go like this, I don't want to make trouble. I don't want to get a fight. I don't want to, he'll never do it or she'll never. Here's what I want everybody to know. You don't need your ex's approval on this. Your ex doesn't even need to be collecting. It doesn't affect anything that they have going on. So watch this. If I had $2,000 a month and my wife took $1,000 a month of this, got it? If I divorced and went over here, my new wife could get $1,000, half of my PIA, and my ex could get half of my PIA. So what I try to explain to somebody is you're not affecting the new person, married or not married, you're not affecting any of their money. This is a right that you have, and if you have a right, been married 10 years, at least 2 years divorced, you can get that. They changed this rule where they said the ex does not have to be collecting. See, if I'm married, I have to be collecting my own benefit for my wife to get half. But the reason they changed this is people were divorced and they were mad. And in spite, I'm not turning mine on. So this is what was happening. We're making people suffer. So the judge came in one day and said, hey, all you gotta do is be 62. I don't need you. I can go, and I tell people, you can go in, you can prove you're married, you can get the benefits, you can look at ex-spouse benefits, your benefits, you can make all this happen. You don't need any help from them. Doesn't affect that. Yeah, one question in the back.
Yeah, you said they get half of the PIA, but if they turn it on at 62, do they get a reduced benefit?
Well, all you're concerned about is whatever the PIA benefit is. So what I go like this, if my PIA is $2,000 and I turned it on early and I'm getting $1,800 or $1,400, my PIA is still here. So if you came to get half of mine and you were at your full retirement age, you're getting half of the PIA, not what I turned on. So you have to be full retirement age, and then you get the half of the PIA. It's really based on your age, not your ex, but that's a good question. So let's go here. We got two people collecting Social Security. One person dies. What happens? You keep the higher of the two, but not both. Not a lot of women that want both. Let me show you how this works. Here we are. Tom and Susan are collecting their benefits, right? Tom dies, Susan gets the whole $3,000, but she loses her own. Can I show you what happens here if you haven't caught this yet? They were making $4,200 finally joint. Tom passed away, Susan makes less money and she files single. If you don't know what's happening here, less money and taxes are going up. This is what we see in retirement with death. People are moving along with stuff, and a death happens, and tax rates go up, and money starts to get eaten up, and if you don't know how to prepare for this, this kind of gets to be messy. But this is what happens. You will lose one of the benefits. Now, you keep that. So my example of making $2,700, but I've delayed to $4,000, if I passed away, my wife gets the whole $4,000. I'm leaving a higher death benefit if I delay. So husband and wife couples, and we're having this conversation, maybe one goes early, maybe one goes later, but we have this conversation about what this is going to look like. Let's move along and talk about if you have a deceased spouse, you're the only person who can do a switch. Meaning if I'm married and my spouse dies and it's at the right age, could I claim their benefit? You could, allowing my own to grow, and then later on switch to my own. You can. If you have a deceased spouse, you still have an option. If you had a government pension, teacher's pension sometimes offsets Social Security, WEP or GOP, the reason I'm not going to go into this, they just passed this new rule where these offsets might not happen. So I would say to be determined, they're still working through this, but it used to be some offsetting on your Social Security benefit. Now they passed a law that says, no, we're not going to have that anymore. If you're somebody who knows what WEP is or GOP, that's somebody who's going to be to this. If you don't know what this is, it doesn't apply to you. Let's talk about taxes. Social Security is subject to tax, federal tax. I can't believe I'm going to tell you this. Most states tax it, but Illinois does not tax your Social Security benefit or your retirement money. What? Yet. Good point. Do they want to? But we're talking about federal tax, but it's ordinary income rate. Whatever your rate is, whatever your tax rate is in retirement, that's what your Social Security is taxed at. But there's this thing called the provisional income formula. I'm highlighting this is where we play the game to try to start mitigating taxes. So let me explain Social Security and provisional income. Here's a married couple. Let's just say they're both getting $30,000 a year Social Security. Everybody with me? Okay, so they're getting $30,000 each, $60,000 total. When they go to their taxes, they only have to file with $30,000 because they take half of the benefit. Then we look at this chart for federal income tax, and we say if you're married and you make less than $32,000, we're just assuming it's all Social Security income. This couple would make $60,000 and pay zero income tax. Everybody see that? Made $60,000 in Social Security, claim $30,000, less than his, no income tax. This is just showing you if you have other sources of income and income comes in, more of your Social Security benefit is taxed. That 85 is not an 85% tax, it's 85% of your benefit is taxed. If I had $1,000, $850 goes into a taxable column based on my ordinary income rate, but you can see that the taxes go up on your Social Security with more income that's coming in. So this is where we're going to start thinking about this a little bit. Let me show you an example here. There's that $30,000 Social Security, right? 60 grand, but we claim 30. Everybody with me here? But let's say they had $100,000 in a CD, so they made 4 grand in interest. So now they're at 34,000 for provisional income. What changed? Well, now 50% of their Social Security benefit is taxed, plus they got to pay tax on the 4% interest. And a small version of this is they come to somebody like me and they go, look, I got an idea here. I can accomplish the same thing, except I'm going to change the tax situation. Well, how? Well, we're going to take that $100,000 CD and we're going to put it into a tax-deferred account that earns 4% interest. So the taxes are deferred for a while. You're not getting the interest on that 1099. What does that do? We take that 4% and defer it down the road, and then it brings our Social Security tax down to 0. So we save the tax on the Social Security, we save the tax on the $4,000, and this is kind of some of the stuff that we start doing in retirement income based on that. That's just a small sample of repositioning these assets. If you don't have an advisor that understands this, then you're going to pay a little higher in taxes, because income planning is different than when you're just putting money in along the way. Here's how you claim a Social Security benefit. You have to apply online, by phone, go to the office. Make a note of these. When you claim a benefit, just know you have the option to take withholding tax out of there. So if you claim a Social Security benefit, you could say withhold some tax. You can have them deduct the Medicare Part B. I'm not claiming a Social Security benefit yet. I'm 68. I'm on Medicare. I'm paying Medicare Part B, but not from Social Security. But if I go to my Social Security, I could say take it out of my check. They also say this for people who delay a little bit. So if you're 62 eligible and you're going in at 63, you want to claim at 63, they're going to offer you, do you want 6 months back pay? You have up to 6 months. I get 2 grand a month, they're going to say you want 12 grand up front. I'm going to tell you from my experience, sucker bet. Listen to this. Yeah, give me the 12 grand. We want to go to Hawaii. We want to do something. Can you go to Hawaii for 12 grand? I don't think so. You could take that money up front, but watch what happens. You've delayed all this time to increase your benefit. And when you go take that payment, they push you back here. So technically you take the money, but then you get this benefit for the rest of your life. So I'd be careful. If you're delayed because you want a higher benefit and you do something like this, you're going to reduce that benefit in the long run. So be careful. Just kind of review what we said. I got to move along. Medicare Part B. This is fun. Circus today. But we are going to be talking about Medicare Part B because Medicare Part B is tied to your Social Security. I want you to understand something in this section for a couple minutes. In our business, if you're looking for Medicare, and I just want you to understand something, if you buy a Medicare supplement or a Medicare Advantage online from Humana, Aetna, Blue Cross, or you buy it from a broker like me, you pay the same price. There is no discount. But if you buy from the online people and you call me and say I need some help as an agent, I got to say I can't help you. So we have an incentive. If you come to us to help you, we get a commission. Not a giant commission, but we get commission if we sell you Medicare. I'm going to tell you, when you start turning 65, you are going to be bulldog. You are going to be hustle. Anybody at 64 right now? You can't hardly go out of your house probably. Everyone's calling you or on every list. Everybody wants to. Why? Because you're eligible at 65 and they want you here, and they're going to lie and scare you. Some people do, not everyone. They're going to scare you on some things I'm about to tell you, and I'm going to educate you so no one pulls the wool over your eyes on this. So watch how this works. When you're eligible for Medicare, when you first turn 65, 3 months before the month you turn 65 and 3 months after, there's a 7-month window here. Everybody see this? They call this the initial election period. I'm new to Medicare. Why is that window important? Well, let me explain. I'm at work, and I'm covered by my work insurance. But now I'm turning 65, and I want to come over to Medicare, but maybe I got a pre-existing condition. Maybe I got cancer. So when I come over to Medicare during this window, 100% guaranteed issue. In other words, I got a pre-existing condition. I come over here during this window, get in. Guaranteed, get accepted. If I don't have any insurance and this window goes by and I'm over here, when I come to Medicare past that window, they go, what's your condition? Now you're going to be underwritten. Now everything starts to happen. So this window is important. They call that the initial election period. But they're gonna call you if you're still working and got insurance at work, and this window goes by, don't worry about it. You could be 69, retiring, leaving work at 69, coming to Medicare, you get the same kind of a period to get Medicare open, guaranteed issue. All they're gonna say to you when you come to Medicare is, did you have insurance at your company? And if you did, so when somebody tells you, you're gonna lose this window, you're gonna lose this window, drop your insurance at work, because I make a commission, come on over, I want your commission. And you get off that work plan, you're not gonna be able to get back on your work plan. This applies to you and your spouse. So if I'm 69 years old and I'm working for a company, and the company is paying my insurance and my wife's not working, we're both on the company insurance at 69. We're leaving and we're coming over here, we both are gonna come in with that guaranteed because we had coverage. They don't wanna break in your coverage. So just know that. Now, talk to somebody who knows a little bit of Medicare. We do Medicare. If you're interested, come see us, or find somebody who's really educated on Medicare. There's a lot of choices today, and there are like 21 companies, Advantage plans, drug plans, all these things. Medicare Part B, A is usually free, but $185 for Medicare Part B. But let me show you something called IRMA. As an income planner, I'm going to introduce you to IRMA. This is the IRMA chart, and this is the 2025. This is that $185 as long as you're in this pig. But if you're down here and you're couples that are during this kind of money, well then that $185 per person doubles. $370 for me, $370 for my wife. Drug plan premiums can increase because you make too much money. Now, sometimes we can't avoid this, but let me tell you what happens sometimes. Inadvertently, people are retiring from work and they go like this. Before I leave, I'm going to take $150,000, hypothetically, I'm going to take $150,000 from my 401k, I'm going to go pay off my house. I want no mortgage on my house. Understand? No problem. But that $150 came on top of the $150 they already make, and for the next 2 years, they've doubled the Medicare Part B for both of them because of IRMA. So what I'm about to tell you is when you're pulling money in retirement, we have to be careful where we're pulling money from, because we got to be concerned about Medicare Part B premium, because if we hit it up, it locks in for 2 years, and sometimes it's there forever because you make too much money, but it's something we should be cautious about. Remember, if you're covered by a work plan, don't sign up. If you have no insurance, go sign up for Medicare. If you have questions on all this, call me. The last thing I would show you is once you have your A and B card, you're going to have an option, 2 different ways to go. You're going to add a supplement and a prescription drug plan, red, and Medicare, or you're going to take the blue plan. This is a Medicare Advantage plan. This is Joe Namath on TV. This is the open enrollment, your bomb. This is different than this. They are not the same. Most every company offers supplements in this. You should know the difference between 2. I would just leave it at this. When you're going to shop around on that, talk to somebody like me that's a broker, because we do both of these kinds of plans. We can help you out. You have a lot of options today. If you are signing up for Medicare, even Part A, you're going to lose your health savings plan. Some people are told, hey, I'm still working. I have a health savings account at work. I'm turning 65, I better go sign up for Medicare Part A. I go, hold it. If you sign up for Medicare Part A or B, you're going to lose your health savings account. Now, you're going to lose contributing to it. If you have money in there, you can still use it. But sometimes that's why we would delay even signing up for Medicare Part A if you've got a health savings account. So we would talk to you about that. Again, you probably won't hear this at some of these other advisors because they don't deal in this and they don't know. And this is when it gets a surprise to you. The last 15 minutes here, I'll go quick. Let me talk about some retirement income strategies, and I'm going to show you some things that we do. If you're interested, you come see me. If you want to do this on your own, go ahead, but I'm going to show you some things that we try to teach people. Strategies I use for my own clients, tax saving moves, how about making money up and down markets. Put this hat on for a second, because we're all getting close here. When you retire and that employer paycheck stops, I don't care who you are, what you make, it's different. It's here. I watch people. Wait, I'm not working anymore. I've been working my whole life. I'm not going to psychologically this starts to change you a little bit, and you don't get that paycheck every different. And you say, wait, I gotta get off my employer plan that I know so well, but now I gotta go to Medicare. This is different. Claiming Social Security and living on Social Security instead of my paycheck, ooh, different. I can't contribute to the 401k anymore. In fact, I'm gonna start using money in the 401k, and for the first time, I'm pulling money out paying tax. Is that gonna affect earnings? I'm just telling you, this is different. What I'm trying to explain to you is this is when you need a different kind of an advisor. If somebody's just managing your money in a portfolio and trying to make you money, I laugh. I had somebody come in the other day and say, well, you know, my advisor did really great. I said, everybody did great the last few years. We all did. But he had an advisor or not, the market's up. Tell me what happens when the market's down. Tell me who's helping you coach on income. Tell me who's doing it. There's more to retirement than just managing your money. So I start getting into this. You're going to go from an accumulation to a distribution, and I tell all the young guys on my team, this is different than this, and we need to understand this. And if somebody is handling you in retirement, you've got to know this. Let me tell you how we do it. First thing we do is we're going to take a look at all your different sources of money to try to say, how are we going to set up an income plan for you? Maybe Social Security, I'm going to look like, and whatever accounts you have, which one of these accounts are we going to start drawing from first? And there should be a strategy to this on the drawdown to make the taxes come out the most efficient way. So we do a lot of this. And I would say you have to have somebody who knows how all this works right now. You're going to have money in retirement. What is your money's purpose? Well, obviously we want to protect some of this money for a long time. We want to grow the money, of course. We need income from this. And what happens if we die? Legacy. If you're just in a stocks and bonds account and you think you're going to do all four of these, you're not. So people come to me with a lot of money at Merrill or wherever they're at. All this stuff is in stocks and bonds. And they say, well, let's start looking at this. Can I protect that money in there? Is that good for legacy? Might be good for income. I'm going to tell you, it's not usually done with one bucket. It's not really that easy to do. People come in with a lot of different accounts. TOD, transfer on death, joint, IRA. If I have you earn an interest every month or a dividend in here, you're going to get a 1099. You're going to need interest payments. You're going to pay tax on that. If I have income coming in an IRA, you're not going to pay tax on that money. It's going to be deferred. So we set our investments up depending on what account you have and how we're going to do it. But I'm going to tell you what works for us is we got to tell you and look at you and say, for the next 25 years, this money has to last you in retirement. And some years are going to be good and some are going to be bad. How do you make it through the bull and the bear? And I put these pictures up here because this really nice lady told me one day, she said, I was talking about the bull markets and bear markets, and she said, which one's the good one? And I said, it is kind of confusing. The bull is the good one, the bear is the bad one, but we are going to have both in retirement. When people come to me, I love this. I have some of my friends' money, and they'll be like this. The market's doing everything. The market goes down. I get this call. Hey, Tim, you watching the market? You see it? Do you see what's happening? Yeah, I see it. So, down a little bit. Oh, my gosh. We are not going to try to time the market. If you think you have an advisor that can time the market, I would say, or you want to do it on your own, do it. But advisors usually don't. How we accomplished it is this. We know we're going to have down periods in the market. In 2022, the market was down. 2024, the market was up. Now, just as something to kind of consider, and I'm giving you a little bit of how we do it, look at these different indexes here. For instance, S&P, which most people know, that's kind of the benchmark of the stock market. 500 U.S.-based companies in the S&P, yes? 30 companies in Dow. Sometimes Microsoft could be in the same. But if one of these companies here has a bad earnings report or something, is the Dow going to jump different than that? Yes, it is, because it affects 30 companies. NASDAQ is all your technology. There's some different reasons. Russell 2000 companies. We invest in these different things for different reasons, and there's a strategy to it. These are all these magnificent 7 artificial intelligence. If you own some of this stuff in a stock, in a portfolio, ETF, whatever, you're on fire right now. Artificial intelligence, it's going to be here to stay, so that's good. But we're going to talk about caution in retirement, because here we go, we're getting ready to retire. We were taught in our school when we were going through securities license and financial, 4% a year is kind of what we would call a safe withdrawal rate. Everybody heard that at one point? You got $1 million, you're pulling 40 grand a year out. That's a safe withdrawal rate. We kind of think we could make it 25 years in retirement with that. Well, watch. Here's somebody starts with $1 million. They're pulling 40 grand a year out. Well, why in 10 years have they lost 2/3 of their money? What? Because the market is losing. The market's losing at the same time I'm pulling 40. The market lost 11, I'm pulling 22. When you're taking a distribution when the market is down, this is going to accelerate the loss. And people go, well, how do we fix that? I say, well, we don't have all our money in that bucket. What I want is if the market's down and you need 40 grand, we're going to pull 40 grand from a bucket that doesn't lose. And we're going to diversify based on the way we set up your money. What I see is most people are in stocks and bonds portfolio, target fund, whatever. Think about your retirement money wherever you are. Some people own individual stocks. But a common thing is, and by the way, this is what we considered conservative. 60% of your portfolio is in equities and 40% is in bonds. Well, why in 2022 was this particular portfolio losing 17%? Wow, sounds like a lot for inflation is the variable that's hurting the bonds. And people come to me with stocks and bonds and say, there was a time we're losing money in both. I say, you got to get out of this. Get out of this model. We don't want you in this model in retirement. We're going to change, we're going to move. We're going to say, we're going to have a stock market that's going to crash, and we're not going to panic. We're going to prepare for it. So usually the way we do this is we don't want all the eggs in one basket. We're going to start splitting the baskets. It's going to look a little bit more like this. I love this. Tim, I want that account that has 100% of the gain. And I want 100% if the market goes down. And it's got to be 100% liquid. And I go, great. Where do I find that? Now, can I split your money, $1 million, into different buckets for protection, for growth, for... Yes. That we can do. So it looks like this. So I have a bucket that's for protection. Indexed annuities, buffered notes. These have protection if the market goes down. They're not getting hit by the market. I would pull from here if the market's down. Some of your money is in stocks or growth or what. This is the one that could be down. So this is going up, but when it's down, we're going to say hold, let that recover a little bit. How about income? Do we want income from bonds? This is kind of what we're doing. We're trying to set up different buckets. We're not just going to be in stocks and bonds. We're going to split the money, and then we're going to set up our income plan based off of that, because here's 4 times in 10 years that we should have pulled from a different bucket of money that didn't have any loss. That's kind of what we do. These are different things that are buffers. Now, indexing, you hear the word indexed annuity, indexed life insurance, anything indexed, fixed indexed, these are protected from the market, and they work like this. Your money in the indexed product, a lot of these are insurance products, some of them are buffered notes, some of them we do at Schwab, we do things, but there's a way we protect money in the market when it goes down. So here's the way it works. The green line could be money in an indexed annuity, meaning you're linked to the market. If the market's going up, you're going to be making some money. Not all of the gains of the market. You want the gains of the market? We got to get all the gains. We got to get in the market. We got to take all the risk. But this one has no risk. So you're making some gains, but now watch this. Here's 2 negative years in the market. Look what happens to your money. It doesn't move. So if I needed 40 grand, I would take it from here, because it didn't. Now when the market rebounds, this rebounds, and of course, this is an account that's protected from the market. We have several investments that are protected from the market. You should have a bucket like this, because you're going to have a day in retirement, you're going to need it, because that's how it's going to go. Now, this indexed annuity kind of does protection, growth, and guaranteed income. I can get guaranteed income for life out of an annuity bucket, and even if the account goes to 0, you still get that payment. I could take $1 million at a Schwab account, and you could take 40 grand a year out of there, but eventually if that market dropped and all that money was gone, you're done. Not in these, they pay you for life. So we look at protecting the principal, growing the tax deferred. Can we turn on income payments for life? This could be one bucket that helps that income. If you haven't looked at these annuities lately, and I've been doing this for a long time, and when I was starting my career, these annuities were not good. We didn't do a lot of them. They weren't. Then they got a little better, but today they're so fantastic. If you have an older annuity, you may want to come and look at swapping it out for a newer annuity. We call it refinance your annuity. The rates are super on these things. I've got 16 to 20% bonuses. They do things that the other ones didn't do. There's a lot of changes in the insurance world, but we'd like to have a piece of your money in something like this for guaranteed income. Let's close this out and talk about taxes, because this is the thing we all know. Your 401k, 403b, 457, IRA, TSP. Anybody have any of these accounts? You know what I'm talking about? Who has a 401k? Okay, when you put money out of your check, did you pay tax? Company match, did you pay any tax? Of course not. Then it grows tax. When do you pay the tax? When you pull the money out. What rate? Whatever your rate is at the time, right? So if your rate is not down in retirement, you're going to pay a higher tax. People walk in, they say, Tim, I got $1 million saved up in my 401k. I say, hey, that's terrific. How much of that is yours? What are you talking about? Because when we make a distribution, counts as income, IRMA, blah, blah. Distribution, if you don't know this, your qualified money, these counts, IRA, 401k, required minimum distribution. What's happening here? The government is saying, because people have a lot of money in retirement. They come and see me, they go, look, I got a 401k, I don't need the money. I got $1 million here. I got all this other money. This happens. I'm going to leave this to my kids. I say, well, you can't just let it sit there, because eventually you're going to get to an age where the government's going to say you've got to start pulling money out and taking an RMD, required minimum distribution. Wow, this is wild. Taxes are, cheap right now. Is there a chance we do it? Here's the new rules on an RMD. 73 currently. So if you turn 73, you got to start making this withdrawal. And what's going to happen is, if you have any of this qualified money, you're going to pull money out this year, pay tax. Pull money out next year, pay tax. Pull money every year until you die. And if I die and it goes to Mike, you got to pull money out, pay tax. Pull money out, pay tax. Okay? If we die and it goes to my kids on an inherited IRA, this is the biggest changes. This is what happened. This is a sneaky one. The inherited IRA just exploded. We used to be able to send these IRAs to our children. These kids would inherit millions of dollars in this money when their parents died. And they could take a small distribution over their lifetime. They called it a stretch IRA. Sometimes they pass it on to the next generation. Not now. You inherit that IRA, you got 10 years to cash that money out. Kids do. Pay all the tax. Right now that's happening. You know what I see? These kids, they'll be like 50 years old at a very high tax bracket, and they're inheriting their parents' money, blowing all this up. And I'm saying we should be thinking about this. Maybe we could do something about that. So the government's plan is RMD. They take at the end of the year, whatever the total amount and all your IRA, 401k, all of this money, they come up with it, the total, and they divide by this uniform lifetime factor, and they come up with an RMD. So there's your lifetime factor at 73. This is when this starts. So to give you an idea, $500,000, 73, that's what you got to take out every year. But they climb and they grow. So at 83, you're pulling a lot more money out of this account. Now, these withdrawals that are coming out of these accounts, I say be aware, you and me, this is a tax bump. Could increase your income tax bracket, could increase your Social Security tax, could increase your Medicare Part B, on and on and on. Somebody dies and they're pulling these RMDs out, now they're going to file single on an RMD. I'm just saying, think about this, start to prepare for this, because I see this every day. And it's not the young kid at Merrill Lynch that's doing this, it's these older people that are saying, wait, the guy said I had a lot of money here, and all of a sudden it's getting eaten alive because it's going and stuff like this. We actually have a book here written by one of our guys on our team, CFP, that talks about these tax advantage wealth strategies. I won't bore you with all that, but we follow a lot of these in our office. I'm going to give you a couple of them. One is, can you do a Roth conversion? Now I'm going to tell you something about this strategy. This is not contributing to a Roth. This is somebody who has a big IRA or a qualified account, and we're going to take some money out and pay tax and put the money in as balance to a Roth. When you're doing a Roth conversion, the rules are different. There's no limits. When you're working, you can only contribute to these accounts. If I had $1 million, I'm not suggesting you did this, but if you took the whole million today, paid the tax and put the balance in an account, then that money would grow in the Roth. You'd never pay tax on that again after time. So that's something that people consider. We like to do it a little bit over time. But you take your money from an IRA and you move it to a Roth IRA. Why? Because then there's no RMDs. And if you pull money out of it, it's never taxed. And if you die, it's not taxed to your kids. This is why we want Roth conversion money. So we do this conversion at times. Now, we always look at your tax brackets, but sometimes I like to show people, if you were married and you were in this category of $200,000, and we could pull $183,000 out of a qualified account and pay tax, we don't even jump your tax bracket. Sometimes that makes sense, because we can eat some of this money now, maybe next year eat some of this money now. Why? Because we're trying to get it over here where it's never taxed. And if I die, so on and so forth. Here's an example. $250,000. We're going to take $50,000 out a year. We're going to pay $10,000 in tax. We're going to put it over here. So get that, $50,000. So we're taking $250,000 and we're converting it to $200,000, never taxed. This eventually goes to $250,000, $300,000, never taxed. Can you do that? We'd like to talk to people about that, see if it makes sense for you. Sometimes we take that same $40,000, $50,000, pay $40,000, but take that $40,000 instead of into a Roth, we put it into a life insurance plan. We're funding a life insurance on a Roth converting vehicle. Why? Because we usually can double the amount tax-free to our loved ones. If you got money you're just trying to leave to your kids, you pull money out, put tax, instead of $200,000 to your kids, you're leaving $400,000 to your kids. So this is another thing that we look at. Life insurance is still a great vehicle for transferring wealth. And you're not doing it with payments, you're doing it with converting some of your assets. Here's another thing, one payment. Sometimes we got somebody with $500,000. They take one payment, pay up a premium, $50,000. Why? Because depending on their age and a few other factors, sometimes they get double on a death benefit. So I paid that up in one payment. If I died, $100,000 tax-free. And then if that money grows over time, I can use this for long-term care. One fast story to close this out. This happened to me. I had a lady, she had about, I think it was like $55,000 in an account. She had $105,000, $55,000 for each kid. That's what it was. She had 2 girls. Tim, this $110,000 is all the money I got. I want to leave it to my kids. But I want to go to Spain with my girlfriend. I don't want to pull from this account. And the daughters are saying, Mom, go. I can't, you know. So here's what I did. I took $50,000 from her 100 and something thousand, put it here. I said, now your kids got the $100,000, tax-free when you die. The other 50, go to Spain, that's kind of how it works. Beautiful thing. So we should be looking at some of that, taking a look at it. I close this out by saying, who's helping you? This is more complicated than most people think. Social Security, income planning, your investments. Do you have the right kind of advisor in retirement? I would close this meeting out like this and ask you for a favor, okay? This is an evaluation form, and I'm going to ask you for your help. If you think I did a good presentation here, you fill it out and you give me a rating. This helps me get in front of other groups like this, so you do me a favor if you fill this out and gave me a rating, because I do get clients from here. I'd appreciate it. Let me explain the rating system. 1 to 5. 1, not good. But if you would fill this out and you would give this to me, I would thank you for that and help you with that. If you wanted to book a time with me and talk about any of these things we mentioned here, I would gladly meet with you, have a discussion, see if it works. No obligation, just a conversation, come on in, we can look at some of these things. Fill that out, give it to them. Please fill this out, give it to Cindy when you're done. Thank you so much for being here. I'm going to be up for questions if you have any questions. Thank you.